You see, I never enter a trade saying, this is definitely going to work. I think that's a very toxic habit to have. And what that does is it helps me not make my losses into worse losses, right? And that is one of the keys in trading. We are all going to lose. The key is don't lose more than you're supposed to lose. Have you ever taken what looked like to be the perfect trade only to find that the market did absolutely nothing afterwards? No win, no loss, just candle after candle moving sideways. And that's when the questions start. Did I get this wrong? Should I just get out? And here's the problem. Most traders think consolidation is a bad sign. I don't. In today's episode of the Trading Coach Podcast, I'm going to show you why the market going nowhere doesn't necessarily mean that your trade is going nowhere, and why the way that you think during these moments could be the difference between you being a consistently profitable trader and becoming your worst enemy. I'll also get vulnerable for a minute and share a few my biggest fear when it comes to trading, and I'd love for you to share yours in the comments section below. All right, let's hop in. A question that recently came up in one of our Monday morning private Q&A sessions was about consolidation and whether the market going sideways for too long is a reason to abandon the trade. And I think this is a really good question because consolidation is one of those things that really messes with traders mentally. And by the way, if you're brand new to technical analysis, consolidation is a period where instead of the market trending directionally, either up or down, it's just simply going sideways, kind of like a crab walking across the sand. And this could be a devastating moment for many traders because when the market isn't giving us that instant gratification that we desire, we naturally start questioning ourselves and every trading decision that we've ever made in our lives. But we can also look at this from a different perspective, and that lack of movement can also build confidence in our trade idea. And that's why I think this is such a great conversation. Now, typically when you're trading at a really good location, the market shouldn't spend too much time there. Think of supply and demand being like home sales, right? If a good opportunity, aka a good house, goes on sale for a good price, that house is going to be gone really, really quick. For example, my neighbors just put their house up for sale a few weeks ago, and in 2 days, they had a cash offer that was way above the asking price. Boom, like this. And yes, it is a good property, but I do think the reason the price went up so much is because, well, you're living next to yours truly. Anyway, if you catch a great reversal point in the market, ideally you want the market to show a rejection of that area and then the market to move off that area with minimal hesitation. But here's where traders make mistakes. As traders, we want the market to validate us immediately. We want to enter the trade, we want to see positive candles appear, and we want the market to tell us, good job, you're right, here's some money. So therefore, we assume that if the market is consolidating, so not giving us that movement, then something must have gone wrong. And the longer this consolidation and therefore the trade plays out, the more time those negative thoughts have to brew and grow and develop in our head. And you know how that goes. Now, when I say traders, I don't mean myself. I mean you guys, because I don't personally see it that way. For me, consolidation is more of a crapshoot, right? If price is moving sideways, it doesn't automatically mean that the market is likely to go up versus going down. It simply means that there's indecision. And how you deal with this indecision is going to have a lot to do with whether you fail or succeed as a trader. So let's look at 2 ways that traders can respond. So trader A is what I call the freak out trader because they freak out, right? They enter a position and now the market starts moving sideways and their thought process sounds something like this. Wait a second. Akil said the most powerful reversals are going to be V reversals, right? They get rejected, they move off right away. If this was a good trade, shouldn't the market have already reversed? Why isn't price moving? The market must not like my trade. This probably isn't going to work. And what happens is they start panicking, they start freaking out, and they see that consolidation as confirmation of them being wrong. And eventually they just say to themselves, you know what? I'm getting out. And they bail on the trade. Been dealing with an abdominal strain, and that was not a great idea. Anyway, let's look at trader B. Trader B thinks about things a little bit differently, right? They say, if I entered the trade at a terrible location and my analysis was completely wrong, what would the market probably do? Well, the market would probably blow up in my face. So the fact that the market is consolidating, aka having a think, and it hasn't blown up in my face, This shows me that there is still a battle happening between the buyers and the sellers at this level. Now, that doesn't mean that I'm guaranteed to be right by any means, absolutely not. But it does tell me something important. It tells me that I'm probably not completely wrong. So just how there are 4 categories that trades fall into: good trade, bad trade, winning trade, losing trade, I actually think there are 4 categories that a trader can fall into in these sort of situations as well. Let's call them blatantly wrong, blatantly right, potentially wrong, and potentially right. And we'll start with blatantly wrong. Blatantly wrong is when the market just destroys your idea, right? You enter a trade, price immediately explodes higher. The market tells you, nope, you're wrong, you're out, adios, goodbye, au revoir, ciao, sayonara, and boom, you're done. Blatantly right, that's that dream scenario. This is where you enter the trade and immediately you get that move that you were looking for. You get that V reversal, price reacts exactly where you expect it, and boom, you do the money dance. Now, sections 3 and 4, potentially wrong and potentially right, this is where we enter our consolidation conversation, because when the market is going sideways, we don't yet have an outcome. And because of that, we may shift to assuming one thing and then to the other thing, which is a very dangerous game, by the way, because as traders, we want to gauge our opinions of future outcomes based off information in the market, not our personal feelings. With that being said, and this is one of the reasons it's so hard to do so, we are humans first and foremost. So it is natural for us to have thoughts, and this is where that psychological battle begins. When price consolidates, we have 2 options. One is we can think negatively, right? Oh no, I'm potentially wrong. And that fear can cause us to exit prematurely. I'm not going to jump again because I hurt myself. Or we can think positively, like, hey, I'm potentially right. Personally, I tend to lead towards the positive side here. This is actually very interesting because naturally I am a pessimist. Every time I take a trade, I assume I'm going to lose. And that's not because I'm bad. I've been really good for almost 2 decades now, but that's just how I manage risks from a mental perspective, right? You see, I never enter a trade saying, this is definitely going to work. I think that's a very toxic habit to have. But just like in poker, once I put my chips onto the table, I mentally accept that I may never see those chips again. And what that does is it helps me not make my losses into worse losses, right? And that is one of the keys in trading. We are all going to lose. The key is don't lose more than you're supposed to lose. And how it helps is that me mentally accepting that loss, I know exactly how much I'm going to lose if the trade doesn't go my way. I've mentally prepared for that. I've accepted that. If you don't accept that, if you're thinking this has to win, it must win, you're not mentally prepared for that loss, then if the market starts moving against you into that red category, you start freaking out, you start panicking, you start making mistakes like moving your stop loss because you want to give yourself more room for the trade to win. And then eventually you end up taking a bigger loss than you were supposed to take in the first place. So the act of you avoiding pain has actually caused you more pain. Kind of dumb when you think about it like that. But when we're caught in the moment and all those emotions are swirling around, we tend to do dumb things. Very similar to how a group of teenage boys act around a cute girl. Damn you, nature. So glad there weren't camera phones back then. Anyway, what this means is that when the market reaches my level and it starts consolidating, I see this as a positive sign that, hey, I haven't lost yet, which means I still have the opportunity to win. Now, as I mentioned before, you want to choose your initial path, right? The positive thinker or the negative thinker. But at the end of the day, the technical rules still matter. So as we get more information on the charts, our opinions are also allowed to change, right? If price consolidates and let's say it breaks and closes in the opposite direction of your trade, then, well, that's new information. Now that trading idea is becoming less attractive and your assessment changes as well. And that's what good traders do, right? We don't marry any opinion. I'm not going to throw it because last time I lost it and I got into a lot of trouble because of that. They allowed the new information to update their decision making, right? So in a way, the market is always communicating with us. Another reason I keep that positive mindset and I never exit early is because of my biggest fear in the market. And that is the fear of missing out. Now, when we usually talk about the fear of missing out, FOMO, we're talking about it in the sense of a trader entering a trade early because they're afraid that the move is going to be made and they're going to miss out and all this money is going to be left on the table. Mine is a little bit different. I don't fear missing a trading opportunity that I'm not supposed to be in. Rather, I really fear missing a trading opportunity that I am supposed to be in. And in the situation of me bailing on a trade while it's in consolidation with the market giving me no sign that I'm more likely to lose than win, I'm doing all the work. And if that trade were to go in my favor and get all the reward, it would get all the reward and I would get nothing. And that really bothers me. And just thinking back, I think the reason that bothers me is because this was the key thing that changed me from struggling trader to successful trader. You guys have heard the story before. I'll do the short version. But I quit 3 jobs to pursue full-time trading. Dumb. I thought I would be more successful in a quicker amount of time and make more money than what I did. Dumb. And pretty much I was getting near the end of my nest egg that I'd saved up to survive while I was learning how to trade. And I was ready to quit and go back to cleaning toilets and whatnot at night for my job. And I did a year-end audit on my trading, and pretty much what I found was that my strategy wasn't the problem, which is what I blamed. It was actually really, really good. The problem was that I was not actually following the strategy, and that's why I was not profitable. And that was kind of the light bulb moment that said, hey, dummy, just follow your plan. And that moment is what allowed me to go on to have a very successful trading career and go on to make these videos for you guys versus cleaning toilets and all the other lovely things that kids and people leave behind in public places. Yay. So here's the lesson. Consolidation doesn't mean that you're wrong. It simply means that the market hasn't made a decision yet. The question isn't, why is price going sideways? It's, what does my trading plan tell me to do next? Now, I'd love to hear from you. What is the biggest psychological challenge that you face as a trader? I've been vulnerable and I shared mine, so share yours as well in the comment section below. And if you enjoyed this episode, hit the like button, subscribe for more trading videos, both on the technical and the psychological side. And make sure you check out this video right here because I think it will be very, very, very good for you. See ya!